Ira Epstein of Linn Associates with your agriculture wrap-up, and this is for Tuesday, the 17th of December, 2019. Well, another update in the grain market, and probably some good news too, as the House of Representatives has now, besides the impeachment hearing that's going on and tomorrow the full vote, they have decided on Thursday to have the full vote of USMCA. That'll go right to the Senate if they pass that, and I'm sure the President will sign that right away. What I haven't heard is Mexico's one of their representatives was due here to talk about that overseeing site, and I haven't heard a word about it. I wonder how that went. I assume that they're settling things on that. I was predicting today that a Monday up, Tuesday down in the stock indices, and I'm half right. 2 of the 4 indices down, 2 are up, so I don't know what to make out of that other than still bullish. And as you can see, you continue to have a good bid into the energy complex as that market is looking at the USMCA, the U.S.-Chinese trade deal, better things happening, U.S. housing doing better. So people are watching things and saying, okay, maybe the energy market could rally a bit here. Of course, I still am of the belief anything near $70 in Brent is very expensive, but we'll see. So let's go to the soybean market. You've had this phenomenal bounce. You're up for the week 21.25 cents the first 2 days of the week. You're honing in on the old resistance point that came in near that 938 level. And I think you'd agree we've made that seasonal low that I was talking about. Maybe a better word is harvest low that we made right through here. Harvest is over. We're already getting estimates for next year's crop size. So they're talking acres. How many acres are going to be planted in beans, wheat, corn, and cotton? I'm seeing reports coming through already. We are approaching this resistance area now in the chart. It's rather formidable, actually, from this 940 all the way up into the 970 area. I'm not saying you can't get through it. I'm saying with this type of rally, you're using an awful lot of energy. Markets find it easier to break. You'll discover that than to rally as you spend your years trading. When we take a look at the swing line, you'll see that the market's got a higher low, higher high. The trend is still up. The market is over the 18-day average. It hung around for 1 day, basically just 1 day at the 100-day average, and then it decided, okay, enough of that, and the market's just continued to run to the upside. It's now in the upper Bollinger Band area. It hit it here, and that was last Friday. Yesterday, the market hit it again, finished the day over at 936. That number's 932.25. And today, the market finished 940.75 with the Bollinger Band 937.25. So you're already 2 days in a row over the upper Bollinger Band, giving a 97% chance, the way that I use my rule of thumb, that when you take consecutive closes over a Bollinger Band, I subtract them against the 5% of the time the market's above or below it. It's a rule of thumb. You can go 6, but it's a pretty good rule. Go look at it yourself. And that means that I'm expecting on pullbacks that, good buying's going to show up. That's not a sign of weakness in the market, but I am very concerned that even though you've got that, you're very overbought. I am concerned that the market is now approaching that Christmas mentality. We're already at the 17th. December 25th is 8 days away. Traders won't be around, so you've got to get nervous now that any markets that are moving start losing some of the volume that you'd normally see. When we come to the meal market, this was yesterday in the meal, just approaching the 100-day average for resistance. I'd have called that resistance between these two numbers, and that's just what you did today. You finally went up to them. In the process, you established higher lows and a higher high. So the market's left its downtrend, and it actually had the bias up. If you look right here, when it settled on Friday, the market had already changed some of the pattern. You had the higher lows and lower highs in place. The bias was up. Market now challenging those areas. I would not be surprised that you just bounce around at this point because the strength of the market isn't in meal. The meal market, it was up today 60 cents, big deal. Here's the strength, soybean oil on a tear to the upside. And what we in the company think has really happened, and a lot of this is priced in already, is that with the African swine fever, the soybean crush that you normally get in China was certainly not as big. And as it's not as big, what takes place is you don't get the soy oil that you need for cooking and other things that you use for everyday living, be it canola, palm oil, but you're not getting the soy oil because you're not crushing as much because you don't have as many pigs. Now, I was reading another report where the USDA is saying another company seems to be making good progress on the African swine fever vaccine. I've seen these reports for the past year. Somebody's going to get a breakthrough, but I don't know which one. I'm covering that tonight in my written update for my subscribers. In the corn market, you've gone from the lower Bollinger Band to now a couple of days up into finally the 100-day average. So like the meal market, we're now up to the combination of resistance and we're overbought in the market. That does not mean this market hasn't established a serious bottom. It has. And of course, it might get that turbocharged thrust if we got some numbers on the U.S.-Chinese trade deal and we knew just exactly what the Chinese were going to buy or forcing themselves to buy. I just don't know that yet. In the wheat market, another day over the upper Bollinger Band, again overbought, a vertical rise where you've gone now from this 516 level, 50 cents higher in 3 trading sessions, basically. And again, this is all part of the USMCA talk, the Chinese-U.S. trade deal talk, and the wheat market took off with that part. In the sugar market, when you lost the embedded reading, and that reading was lost right here yesterday, that sets up the possibility of price and the 18-day average breaking to each other. And that seems to be what the market is trying to do. Once it gets down there, well, it's made its objective, and we'll see what the next phase of the market wants to be, assuming it gets there. Want to get your head handed to you? Enjoy the coffee market. And it's not easy to have a cup with it. What the market did is it lost the embedded reading on Friday. Therefore, unless you take out this high, you would say that the market's got a good chance it's going to break back to the 18-day average. Yesterday it goes up, takes out that important high, stalls. Now the market starts failing again. It makes a higher high, closes lower, and again loses the embedded reading. See that? This is a sign of price exhaustion typically. Doesn't have to be, obviously, but it often, I've seen this pattern, and it leads to the market trying to come back down a little bit here. We'll see. But you're getting moves of 500 points at a time. And remember, 500 points is almost, what, $1,700 or so every day. That's pretty bold moves. Cocoa market. My eye goes to the oversold condition. We had hit the lower Bollinger Band, bounced back to that line in the sand, as I refer it, the 18-day average, fell again, established a downtrend today, but you're getting a downtrend in an oversold condition right against the lower Bollinger Band. Again, I think a lot of this is holiday-type trading. In the cotton market, momentum is trying to correct to the downside in a market that's in an uptrend. You have had higher lows, higher highs. I'm looking for support in the neighborhood of that line in the sand, that 18-day average of closes. And again, the market is working to get out of an overbought condition. It's got to get both of these numbers out of the 70 level. So that's what I think is going on there. Cattle market, to me, doesn't break very much, but it is overbought. It ran into the resistance on the first challenge of the upper Bollinger Band, stalled out. The trend is up. Supports back at the 18-day average, as long as you don't take out these lows back here. And specifically, this low of 124.35 still looks to me as though the trend is up. And what the market is doing is, if you'll notice how you're breaking down here, you've gotten these numbers away from over 70. Therefore, you've got a correction in place, but not a trend change, and the market's already out of overbought condition. In the feeder cattle market, and I have moved to the March here, the market got up to its upper Bollinger Band, and like the live cattle, it's trying to correct a bit. It is overbought. So the fat cattle's looking better than the feeder cattle, and we do have a cattle on feed report coming up. I just put it in my report. I think it's right around the corner, could be Friday. We have also got higher lows, higher highs. You can see the market in the hog market overbought. You've got a reading over 70. Any reading over 70 without both numbers going over and staying over 80 is an overbought condition. So I'm looking at the resistance here. I expect solid resistance between the Bollinger Band and the 100-day average. And again, like the grains, should you get word at any point that China says, oh, it's buying a lot of pork for whatever reason to make up that 50 billion in goods they're supposed to buy from the U.S., well, that's the danger to the bears here, because you could get that type of announcement and just be gone in a heartbeat. You just don't know where you're going on it. You know, one of the things I look at in markets like this, and I was looking at it today in the sugar market early on, is pivot points. Now, what pivot points are is it's a formula, and we teach it in a 3-part video. It's a formula you learn that uses the previous days, and you're looking at the high, the low, the open, the close, and you're coming up with an average, a number. And via that formula, you find what's called the pivot. And that's this white line. Obviously, charting techniques can do it for you, but if you learn how things work, you understand them. You come up with the resistance level above the market, 1 and 2. Some people can go out even more than that. FX traders will go out, I've seen them, 3 to 5. As you come down, you're looking for support level 1 and 2. The idea there is you're trying to find when the market is overdoing itself, looking to be a contra trader. Now, that can mean covering shorts while the market's coming down hard. It could be that you're going short, as an example. After you get a rally in the market up to the first resistance level, the market gets overbought as it's turning down. You're trying to time all that. So I've created a 3-video series. It is free, and it teaches you, number 1, the formula, and it's all animation and real charts, so it's 2 ways. Number 2, what you get with it is you're going to learn how to plot it on a chart. And number 3, you're going to learn how to use slow stochastics with it. All you need to do is go to our website, www.iraepstein.com, and when you're there, the very next thing you do is you'll see on the bottom right, Ira's free offers. Click on it, sign up for what you want, and we'll put it in your mailbox, your email box. I'm Ira Epstein. You have a good day.